Ladies and gentlemen, good day and welcome to Laxmi Machine Works Limited Quarter 2 of FY2023-24 earnings call hosted by NSDL. As a reminder, please note that the participants' lines will be in listen-only mode and there will be opportunity to ask questions after the brief by the company officials. Should you require any assistance during the conference call and to raise questions, please signal the operator by raising hands. Please note that this call is being recorded. This is Sameer from NSDL and we have with us Mr. V. Senthil, Chief Financial Officer, and B. Dhanalaxmi, Senior General Manager of the company. And over to you, sir.
Good afternoon, everyone, and thank you for joining the Laxmi Machine Works Limited earning call for Q2 FY2023-24. We will have a brief about the overall performance of the company for the period ended September 23, followed by an interactive session. I would like to also clarify that certain statements made and the discussion in the conference will be forward-looking in nature. To begin with, let me explain about the overall performance of the company, and then we'll proceed to segment-wise performance and then consolidated performance. The financial results have been posted on the company's website and hope you had opportunity to go through the same. The turnover for the quarter ended September 23 is 1,285 crores as against 1,155 crores in June 23. Which is an increase of 11%. The company has achieved a H1 turnover of 2,441 crores for the period as against 2,106 crores for the corresponding previous period, which is a 16% increase of turnover. This is in alignment with the peak utilization of our capacities in the business and our continued effort to meet with the customer orders. The PBT stands at 270 crores for the current period as against 222 crores for the previous period. This is an increase of 22% of PBT. With respect to division-wise revenues, TMT revenue for the period stands at 1,990 crores as against 1,701 crores for the corresponding previous period, resulting in an increase of 17%. TMT revenue for the period September 23, quarter ended September 23 is at 1,046 crores as against 944 crores in the previous quarter, resulting in an increase of 11%. When compared to the quarter ended September 22, the increase is 12%. And the profit stands at 189 crores as compared to 162 crores for the corresponding period last year. Currently, we hold an order book of 4,300 crores, which have been lined up for execution. The ratio of domestic sales versus exports versus spares, it is almost 75% of domestic sales, 11% of exports and 14% of spares. Now I move to LMW Middle East. The turnover in LMW Middle East, which stands at 148 crores for the half year as against a comparative 9 crores. As we know, the company was not operational during the last year fully, hence the lower number in the previous year. The company is fully functional currently. The order book on export stands at close to around 400 crores. In LMW China, we have been able to clock a turnover of 10 crores, and we will discuss in detail when we go into division-wise. And for the comparative period last year, it stood at 146 crores. There has been the order book on hand at LMW China stands at around 22 crores. Now, on the machine tool division and the foundry, the turnover in the machine tool division and foundry is 515 crores for the half year ended September 23 as against 495 crores for the corresponding previous period. Out of this, 10% is foundry turnover. The balance is towards turnover of machine tool business. With respect to ATC, the turnover stands at 84 crores for the current H1, and the corresponding period previous H1 stands at 53 crores. And again, the reason we have been able to get a higher, fairly significant increase in turnover has been because of the fact that there are a lot of orders which are pulled in, and this has resulted in a significant increase in the turnover and the corresponding profitability of this particular division. I think this is the brief from our side, and I think we are back to the discussion. So we can start the interactive session, Mr. Samir.
Sure, sir. Thank you so much. We would like to go ahead with the interactive session. I would request the attendees to please raise hands if you would like to ask questions after communication of your name and status. And we would also request people to go ahead with raising your hands so that we can take your questions accordingly. The first person with the hand raised is Mr. Chetan Doshi. Mr. Chetan, you have been unmuted. Mr. Chetan, we are ready for your question. You have been unmuted.
First of all, congratulations for the good set of numbers.
Mr. Chetan, we are not able to hear you very well. Can you kindly be a little bit louder, please?
Yeah, sure. Am I audible now, sir? Am I audible?
Yeah, you are audible. You're audible, but a little bit low. Please go on, sir. Please go on.
First of all, congratulations for the excellent set of numbers. My first question is that can you throw some light on LMW Aerospace Limited? What are your future plans and how you are going to go ahead for the next 6 months? What are your targets? Where you want to put this division in coming 6 months? Because see, in this results you have shown some loss after on turnover of say 160 crores. So what is the break even for this unit?
Okay, and any further questions?
Another thing is that there is one single investor who is holding large chunk of shares. So as far as the company is concerned, do you allow this kind of, it's a threat to the takeover, or you are planning to have him on the board? What is the company's scenario on this?
Okay, sir. Any other questions?
No, thank you.
Okay. Thank you for the question. I think with respect to aerospace, I quite couldn't get, he said 160 crores loss. I'm not very clear that 160 crores on loss the question, but let me try to answer on the ATC side. See, the ATC business, what we have over the last few years transformed this into, there are two parts to this business. One is the metallics business and one is the composite business. And whilst we started off with metallics, over the last 4 years we have invested in composite as well. Now, we have stabilized the metallic business to a large extent, and that is where, whilst 2 years back we have kind of seen loss, last 1.5 years we are consistently able to focus our capacities on specific orders which are repeating nature. They are all export orders and they are all towards aircraft parts. And these are all types of parts, engine parts, door parts, there are various types of parts. Now, the benefit in this particular aerospace business is the fact that we have long-term orders. So when I am talking about long-term orders, we are talking about orders for 5 years. And during COVID, when these orders were there, the pull was not happening. And today, for last 1.5 to 2 years, lot of pull, at least for last 1.5 years. So we are able to execute this. Now, this business also requires us to, plan for these in advance. So which basically means that you're asking me for 6 months. In fact, we plan for this for a year in advance, because the way the metallics business we operate in, because it's a very large field, aerospace is a very large field to operate, and the way where we are operating in a space where our raw materials are, most of it is imported. These have long lead times, and in a sense, because we have a 5-year long order book, we also plan for that long, not in terms of raw material, but at least we plan for 6 months to a year in terms of raw material and other things. The order book in this particular ATC on metallics stands at close to 300 odd crores, which needs to get executed over a period of 4 to 5 years. So there will be a constant, the run rates can be made so long as the pull happens. Now, where do you want to get to? That is where we have invested a lot in composites over the last, like I said, couple of years, or almost 4 years we have been investing in composite, where we have built capacities, where we continue to build capacities in the composite business. However, the composite business is largely dependent on the currently the order books are based on programs which the government runs, and our capacities have been meant for that. And we are finding that we have not come to a utilization level within this particular capacity utilization within this particular division, which gives us that break-even. And as you can see, currently, current quarter, we are doing close to 10 crores. That is almost the margins here are close to 15 to 18%. I think this is the margin which generally is possible, except the fact that these are possible only when there is a full complete capacity utilization, and we have to continue to invest in this particular business. So the race here is to achieve that incremental turnover and achieve new orders and achieve full capacity as we go forward. So since you asked me the target for this is that we at least anticipate whatever we invested, we still are yet to see a 1:1 return between metallics and the composite. We have invested close to 120 to 150 odd crores. I think we ideally would like to have 1:1 return on this in terms of a turnover. And if we actually add material cost also, it will definitely go up. But we are not yet there because we have capacities like I mentioned, and it is something which we are working very closely to ensure that our capacities gets used. Now, I think your second question on a large shareholder, I think this has been a shareholder who has been there for quite a long time with us. I think I'm not very clear what the question actually meant, but I mean, you have as much information as anyone else, and you know what our public shareholding is. Okay, thank you. Back to you, Mr. Samir. Can we go to the next question, please?
Sure, sir. Thank you so much for answering the previous one. Going ahead to the next question, we have with us Mr. Manish Goyal. Mr. Manish, you have been unmuted, and we can also have your video turned on if you would like.
Sorry, can you hear me, sir?
I can hear Mr. Manish.
Yeah. So, excuse me for the video, bandwidth is not so great. Sir, I have several questions because ideally I get only one chance to ask the question. I would clarify on a couple of things and I have set of questions. So, one is that you mentioned order book of 4,300 crores, that is purely domestic order book. And the exports order of 400 crores you mentioned was from India or it was from Middle East? That is one clarification, two clarifications I would want to have from you. As far as, so I think that total revenue of 160 crores is, I think, both put together. What the previous gentleman was asking was, I think, for these two textile machinery subsidiaries where we have reported a loss of 0.7 crores as per the auditor note in your results. So, and maybe if you can explain us to why China has been doing so badly in terms of our revenues and the order book. Sir, on the exports, when we give the number, so have you given the number of 75%, 11% and 14%? Is it for first half or is it for quarter two? And in respect to this thing, exports, does it include, this is only from exports from India entity and doesn't include the overseas entity? And in that case, that means the spares would have that export contribution. So if you can give the specific numbers as to what is the international revenue and how much is the domestic spares, that should be helpful. And sir, on the machine tool business, we still see that the margins are quite weak, despite we have taken a price hike in recent past. So if you can help us with that, number one. Number two, how is the order pipeline in the machine tool business? We are seeing a lot of investments from electronic manufacturing segment in India. So have we started getting orders from them as well, or are there active inquiry pipeline from them? Have we started our new facility and what will be the potential revenue capacity from that new facility? And what is the status on, sir, our 5-axis machine? Have we probably launched it in the market, or what is the near-term plan, sir? And maybe if you can allow more questions, I can come back again. But
Mr. Manish, please ask. I made a note of everything. We'll tell you, please.
Yeah, so maybe at least with benefit of others, I may come back in the queue, but maybe if you can answer that.
Fine. Thank you. I think I'm sure it will benefit everyone else. Okay, let me take TMD first. TMD, when we say 4,300 crores, we are talking about pure domestic order book of 4,300 crores, and the active order book within this 4,300 crores is close to 3,300 odd crores is the active order book within this. When we say 400 crores of export orders, these are pure export orders. These are also orders which are executable out of India and out of Middle East. 10% perhaps out of this, or 15% out of this are the orders which have started getting booked in Middle East. Ideally, as we go into the future, the entire work is being done out of Middle East, and the order book would basically stand in the hands of Middle East in the future, because the entire structure, everything is for global, could be handled out of our Middle East office. Now, let me also throw some light on our exports and in terms of China specifically. I think we should remember that in China, we had been not able to get into China till late of December last year. So somewhere post Chinese New Year, we have been able to get into China. So that is almost in Q4, so somewhere in the Q4 of last year is what we were able to get into China. And over multiple calls, we have been mentioning that while we had literally been down to one gentleman as against we had at least close to a dozen people taken care of from India in China, but since we could not actually physically go there because of all the issues and the way the business works there, we have not been able to establish a lot of running orders. And China had a very strict COVID policy, as you are aware of and what we have informed in the past. So the outcome of what we see here today is the fact that there has been a gap in our addressing the market there because our service teams or sales teams were not present there, and with a one person it was not quite possible. So we have been able to get export orders, we have been able to execute domestic orders, but this gap has come because we now we have sent people. Last 6 months we have been reinforcing our team, and we have sent a complete set of team into China. So this is going to take some amount of time to re-establish this. And we have to appreciate the fact that 3 years we had not had anyone, almost 3 years of COVID, but at least 2 years, 1.5 years to 2 years, we are hardly been, it has been a tough time for us there. That is the reason we are seeing this gap. And we are doing all what is required to get the orders back as far as China is concerned. The profitability angle on the overall 160 odd crores, yes, the external turnover from these two places is 160, but there is a profit in the Middle East and there is a loss in China, and that is where they are negating each other, and there has been a net zero impact. I think that addresses both the China question and the profitability of the export, both Middle East and China. Now coming to 75, 11 and 14, when we talk about, when we give these numbers out, when we say 14% spares, we are talking purely on the domestic spare side. For us, machinery and export spares, everything goes as exports because ultimately it's exports. So we are talking about 75% domestic machinery and 14% of domestic spares and 11% of all exports put together. And the export turnover, what we said in Middle East is over and top of the exports, what we are declaring, what we are mentioning. So that 75, 11 and 14 is applicable to the standalone turnover of TMD. I think I've covered all the TMD questions. Now coming to machine tool division. As I always say, the machine tool division, the order pipelines are always 1.5 months to 2 months, not more than that. So, whatever you see is, you can calculate it for another 1.5 months, and that would be the pipeline. With respect to the margins, yes, we are seeing incremental and turnover slowly just creeping on. We would like to inform that, and we have also been talking about it. We have been saying that we have added capacities, we have added additional assembly space of close to 150,000 square feet, and there's an increased cost which we are incurring, and that is reflected in the fact of the creepingly slower margins going up. One correction, I think, which I would like to make, this year we have not done a price revision as far as machine tool division is concerned. We did a price revision the previous year. Whilst for TMD we did do a price revision, for MTD we did not do a price revision in the current year. With all our capacities, which I've already mentioned in the past, we are capable of reaching 1,000 crores of turnover with the existing capacities as it is. and we have invested for this kind of capacity. I think that covers all the questions. I think back to you, Mr. Sanil.
Thank you so much, sir. Thank you. Proceeding with the next person with the raised hand, we have with us Mr. Rishabh. Mr. Rishabh, you have been unmuted.
Hi, sir.
We can also have your video turned on if you like. Yes, sir, you're audible.
Yeah, my first question was in this year's AGM, Mr. Sanjay spoke about the big opportunity from autoconno winding and jet spinning. So I just want to understand how many years before we see some significant contribution from these two products in the overall TMD portfolio. And my second question is there any margin differential between these two products and the existing TMD product pipeline? And if yes, if you can quantify how much is the margin differential here? And secondly, sir, on the ATC division, you mentioned that we have demand visibility for the next 5 years. So how soon, sir, before we fully ramp up the existing facility and we might expedite the capex plans here in the ATC division? And one more question here is, are you bidding for any major orders? If you could share some highlights, because you said we are on 300 crores of order book, so that might get achieved in the next one or 2 years. So after that, what is the game plan here, sir?
Okay, thank you. I think I also will cover the 5 axis which Mr. Manish Goyal asked. I think I missed it over there. So TMD, yes, we are in the process. While our chairman spoke about both the autoconner and the airjet, the winder machine and the airjet machine. We are coming out with the winder first, and our target, like I have also mentioned in the past, I think we are in the process of launching the product. There will be a limited launch. We will inform you where these machines are when these things happen. It is slated for Q4 of the current year. In terms of the numbers, where we see the numbers, I think it's too soon. I may not want to comment now. I think once the commercial launch is done, I think that will be the time I would be happy to share what the anticipated numbers are, and we will definitely do that. With respect to the 5-axis machine, Mr. Goyal, I think the answer remains the same. Whilst the commercial launch of it has not happened, so I have not been able to, I can't give you the numbers and where it is kind of placed. So we would like to leave it at that. With respect to ATC, okay, I think the question on ATC is that, yes, we have a lot of opportunity in terms of what we would like to do, and we have to pick and choose that opportunity very carefully. And the current capacities today, as we see, the current capacities are pretty much full with respect to what we are delivering itself. The 300 odd crores of order book over next 4 years, on an average, on close to 4 years of order book. Now, this is not something which we will deliver, because like I already mentioned, this is a pipeline order. So we sign long-term contracts, and when you add up all these things, this is the number it comes to. It's close to 300, 400 crores. It's almost 100 crores of requirements a year. So our effort is to keep investing in capex as we try and throw out the new set of components for which we take order. So your question on the order pipeline, I think we work on a similar set of numbers. So we are whatever you see as a yearly turnover, our effort, generally our pipeline is full of similar set of orders where we have to do our RFQs. And as you know, this is a completely L1 kind of a scenario where we have to bid, and once we are able to bid and we are able to establish, then we go into what we call FAI, and then we go into regularized production. Again, this is a long-term process. So when we start now, by the time we do a RFQ to conversion to a regular production, it may be anywhere from 12 months to upwards of 18 months or 24 months, depending on where they are currently sourcing and where they want to exit and they want to come to us. So the plan here is invest where we would like to kind of grow, which would be high value added components, and the type of parts also we want to get into. So we have got the risk in this business is also quite high. The liabilities are quite high. So we have to be also very clear in where we would like to place ourselves. So we continue to invest and we continue to grow and we continue to do affairs, and that you will see. So already this year we have invested in ATC. Last year also we have invested in ATC, and you will see year on year we will continue to invest. But this investment will not only be in metallics but also in composites, and that's where I explained initially that we look at this business as two distinct businesses. Of course, both get reported under ATC, but these are two different things, and we need to grow in the composite side as well. And that is where all the investments are going to. The investments is going to go in, and that is the right capital allocation strategy for us. Okay, thank you. Back to you, Mr. Samir.
Thank you so much, sir. Thank you. Next, we have with us Mr. Aniket Mittal. Sir, we are ready for your question. Mr. Aniket? Yes, sir. Yes, sir.
Yeah. So, few questions, sir. Firstly, on the ETC front, again, if you could quantify the type of investments that you would be doing on the metallics piece. And secondly, on the composite front, I think you've made some 70 crores worth of investments. So what is the maximum turnover that the composites piece can achieve for us? Secondly, on the MTD piece, if you could talk about the mix that is there currently between the turning machines and the special purpose machines, and also provide us some understanding on what's the margin difference between the two and the reason for that. And thirdly, if you could just share your outlook on the textile machine division. The order book has come down, particularly the active one is about 3,300 crores. If you could dwell a bit on that. The fourth question that I had, and I'll squeeze this in, is when I look at the annual report, the miscellaneous expenses are almost about 8% of your overall other expenses. So if you could just highlight what does these miscellaneous expenses entail? Those are my questions. Thank you.
Okay. With respect to the type of investments in machine tool division, I think the first thing was the type of investments in ATC. In ATC, the investments which on the metallic side would basically be metal cutting machines, predominantly are metal cutting machines in terms of heavy investments. Our shop, we have a special coating shop, we got a sheet metal shop, we got a machine shop, we got an assembly area. So, but within all these things, the special coating shops and the metallic machine shops are the ones which generally take the highest investments. With respect to and where we would like to invest, I think this would be the two areas we will be investing, because this entire metallics is about metallic parts and removal of metal. I think that is the entire most of the business about. With respect to the composite, I mean, it's a variety. I mean, as you can understand, composite is layering of material and baking of material, and then there's a lot of tooling involved in it. I mean, it is more technical in that sense. And we are investing in quality equipments. We are investing in large the clean rooms and many things along in the composite side of the business. With respect to composite, whilst we have invested close to 70 odd crores, I mean, like I already mentioned, our expectation is 1:1 or 1:1.5 kind of turnover on this business. So yes, I mean, we have invested 50 to 60 odd or 70 crores. We would expect a similar kind of return in terms of the composite business. But you should also understand that in certain cases, the material is issued by in certain cases the material is issued by the customer. In such cases, you would only find the value addition which comes as a turnover here. But we know where we need to be as far as composite is concerned. Now, coming to the machine tool division, the percentage of turnover between turning centers and machining centers, we still have close to 80% of our machines are turning center machines. On the margin side, there's at least the turning centers are having a higher margin compared to our machining centers. We may not want to share the margins with you on the call. But why the machining center margins are lower? Because our market share and it's a fairly new, it's a developing market for us, and that's the call we have taken as far as the machining centers are concerned. TMD, I mean, again, thanks for the question. As you can see, yes, the order books have reduced. We are currently using our existing order books for the delivery. The industry has gone through a very tough time, and it has not been a very comfortable last 6 months. And it is not only within India, I think it is globally, it has been quite challenging. Again, various countries have got various challenges, and every quarter we are going through some or other type of a challenge. With the latest one, which has started less than a month back. I think we see that our anticipation is that we have seen the slowdown from Q3 of last year. I think we have to be Q3 of yes. I think we have to be careful really to say when it's going to go back up. We don't have a clarity at a global level to say when things are going to come back to a normal situation, and that definitely we are very aware of this particular challenge what we face. The prices on cotton, it has been volatile, and now it is for last perhaps 6 weeks it has been steady, and the geopolitics of it, the fact that the movement of fabric between countries, a lot of things are affecting this. But one thing we still feel is, again, going back, we know that a continued slowdown wouldn't be the case. There will be a time where the investors in the mills, the promoters of the mills would be comfortable enough to restart the orders and then start picking up the machines and start issuing new purchase orders and start picking up the machines. I think we are sure it's going to come, but we can't really give you a timeline in terms of 3 months or whatever by when this will happen. I think with respect to the miscellaneous expenditure, I think there are certain expenses like advertisement, travel, and others which are part of this miscellaneous expenditure. Okay, thank you. Back to you, Mr. Samir.
Thank you so much, sir. Thank you. Going ahead with the next person with the raised hand, we have with us Forum Makim. You have been unmuted. You can also have your video turned on if you like.
Hello, sir. Congratulations on a good set of numbers. Sir, we spoke about entering into some new products. So one of our holding companies, Laxmi Electrical, is talking about entering into segments like smart meter and electric vehicle charging systems. So could you shed some light on the same?
Ma'am, any other questions?
No. That's it. Thank you.
And LEC is a listed entity, independent listed entity. It's nothing to do with us. So I'm sorry I can't answer that question. You need to talk to them. Thank you. Back to you, Mr. Singh.
Thank you so much, sir. Thank you. Going ahead with the next person, we have with us Mr. Ritvik Sheth.
Yeah. Hi. Good evening, sir. Am I audible?
Very audible, Mr. Ritvik. Please.
Yeah. Sir, most of the questions have been answered. Just a couple of questions. Firstly, you extensively mentioned about the textile environment. Last 1 year it has been soft and we don't know when it will recover. So going forward, where is our comfortable order book in terms of current revenue run rate? If you can give us a sense on that. Is 4,000 crores a reasonable, which gives us a 12-month visibility on the domestic front? So is that a reasonable order book currently? And second question is on machine tool. Earlier, one of the participants has on the 5-axis machine. I believe we have trying to get into this market since a while. So, is there any hindrance in terms of technology that we have that we are not able to get it commercialized? Or wanted your thoughts on that on the 5-axis machine. Second question on the machine tool segment is, what is the realization for us on a blended level, the machining centers and the turning centers, and where do you expect this to move over the next 3 years, assuming we go up the value chain, we launch the 5-axis machine sometime in the future. So where can this realization per machine go? And my last question is on the dividend payout policy. Sir, we have very, very strong balance sheet with 1,000 crore plus cash on the books and strong cash flow as well. So now, what is the thought process of the board? If you can share, on the dividend payout policy, because if we look, it is less than 50% over the last few years. With this strong balance sheet, is there what is the thought process on the dividend payout policy? So that's it from my side, and best wishes for the upcoming festival season. Thank you.
Yep. Thank you, Mr. Ritvik. I think I did notice that you raised the hand at the first, and I think somehow got off to this one ladder. Okay. Now, with respect to the comfortable order book, of course, we are all comfortable if we are sitting on 6,000 crores. And if you ask me when I'm 6,000, I will say I'm comfortable if I'm sitting at 10,000 crores. I think we know the business doesn't work like that. I mean, this is the end of the day. Textile machinery is a highly capex-driven business, and it is subject to economic cycles and geopolitical cycles everywhere. And today, the environment we are in is very, very challenging. I mean, I just don't want to start because everyone knows what's happening in various parts of the world, and you are reading it, you are seeing it, and we are experiencing it. Is 4,000 crores good enough? That's what we have to live with. And whilst all effort is made to retain and increase our market share and introduce new innovative products, I think that is where the entire effort of the management goes during these times when we see that the world is uncertain. And how do we then bring in stability within the team and within the company, and that is where we try to focus on. We are okay with the current order book, and if we are able to build on it, I think the entire effort today is going in that, like I already mentioned. But as you can see, if you go back perhaps little bit prior to COVID, we are sitting on half this order book also. But irrespective of where we are on the order book, the effort is always towards market share and innovation and innovative products to address and bring down the cost to the end customer and produce the best possible yarn at the lowest possible price. I think that is what we continue to do. With respect to the machine tool, 5-axis machine in terms of technology, this I always have maintained also in the past. Machine tool division is something where we buy out most of the components, right? We make certain very critical components, and our procurement basket is on the larger side compared to what we make inside with all the electronics and high precision components. But end of the day, the product which comes out should meet certain quality standards, and that is something which is critical to us when we put a product out there. And that is where the testing and all of this continues, and that's where like I said, I was not going to give any numbers on this product. And when it is out there, it is out there. Once we commercialize it, we'll definitely let you know, and we can talk numbers from there on. In terms of on the blended value, I think our value on an average comes to around 22 to 24 lakhs kind of a scenario. But for us, I think this particular business, we have to understand machining centers are a lot more expensive than turning centers. And one more thing is the solution, that is, there are other bits and pieces which is put on the machine, and it's a solution which is being given. So there are various ways in which the value chain of this machine tool business works. It goes from standard machine, it goes to a solution which is being given to the customer. In this, you have both turning centers and machining centers, and we do not make any special purpose machines. I think that was one of your questions, and we don't make any special purpose machines. What we give out as solutions along with the machines, that could be in terms of productivity and robotics or whatnot. With respect to the dividend payout, of course, our dividend policy. We continue to follow the dividend policy, and we continue to be guided by what the board decides as far as the dividend policy is concerned. Okay. Thank you. Back to Mr. Samir.
Thank you so much, sir. Thank you. Proceeding ahead with the next person with the raised hand, we have with us Anant Shenoy. Sir, you have been unmuted.
Able?
We can hear you, Mr. Anant.
Okay. I had 2-3 questions. First one is about the machine tool division. Overall, can you talk about our capacity utilization in this division, and at industry level also, where do you see the capacity utilization currently? You mentioned in response to an earlier question about 1,000 crore is our total capacity, but we have already done 270 odd crore in one quarter. My next question is about special purpose machines. You mentioned that we don't do special purpose machines, but we give solutions. Like at the industry level, we see a lot of companies do special purpose machines. Like why we don't do, and what is the rationale for not doing that? And my third question is about, like, if I see the machine tool division margins, before COVID we used to do double-digit margins. Now we are at a single digit. So, like, what is the reason for this margin to, like before COVID, to have higher margins and now it's lower? And under what scenarios we can reach the pre-COVID like margins? And my last question is about general working capital in this division, and do we get any advance from customers in this division? If so, how much, like roughly 5% or 10% of the sales, like or order book? Can you talk about that, please? Thank you.
Thank you. See, when I mentioned 2 things. One, I said our current capacity stand at 1,000 odd crores, and I also said we are expanding in terms of the square footage also for this particular division. And what we generally maintain and what we are told also is that fairly for this division, what we require is an assembly space, and what we require are machine shops. Because we pour our own foundry, we have our own foundry, we pour our own castings. So these are the two critical investments as far as enhancement of capacity is concerned for this particular division. So once that comes in, and we expect it to come in the full-fledged expansion to get completed, because currently we are investing in that. We are putting up buildings, we are putting up, all that comes in. Perhaps by end of the current year, it would come in, and it will give us a possibility of another 20% capability to scale up our capacities. That is what we are currently looking at. I think your question on the margins, what we have done over the last, again, if you had followed us through the last 4 years in this division, when we have been increasing where we have been increasing capacities and doing higher and higher turnover. Previously it was turning centers, and we have been introducing newer set of machines on the machining center side. We got a series called the J series, and that goes from J1 to J9. And these machining centers today, which constitutes close to 20% of the turnover, are at a slightly lower margin, which was also, I think, one of the questions which Mr. Ankit Mittal had asked. So that is the reason the margins, whilst we are able to get a higher turnover, the product mix is one of the reasons why we see margins have kind of tapered down. Plus the fact that we have invested in these additional capacities, and we have not still gotten to what we already built 2 years back is the 1,000 crores. So we've got capacities, we've got everything, but the cost is there, but we are not achieved the 1,000, and that is the reason. These are the two critical reasons why we see slight dip in margins. The way we run this particular business, similar to TMD, we get a 10% advance on orders. We also have machines which are booked, are paid for, and on delivery within 7 days anywhere in the country. So you can go onto our website today, you can book a turning center, and Kashmir to Kanyakumari, 7 days we can deliver these machines. These are book and bill machines. So we have inventories which we build, and that's the way the business works. So I think that answers all the questions. Back to Mr. Samir.
Thank you so much, sir. Thank you. Going ahead, we have with us Mr. Abhineet Anand. Sir, you have been unmuted, and we are ready for your question.
Thanks for the opportunity. So my first question is, F23, how much million spindles did you deliver, and 1H of this year, how much have we delivered? Second is that presently, what's a typical per spindle broad price versus what it was pre-COVID? And third is that in textile division, how much do we import components? And fourth is that, we have been talking about PLIs and etc. that the government is implementing, but a lot of those are more focused towards garmenting. So do we have more products which actually suffice to that segment of textile? Thank you. Those are my questions.
So what was the second question, please?
The question was basically on per spindle basis, what is the broad price range here? And also now versus pre-COVID.
Okay. So if you take 2022-23, our total spindle delivery was closer to 2 million spindles. It's what we have delivered. And that is closer to the number in total within India and abroad. Now, with respect to the price per spindle, we have we had two price revisions. Our price revisions stand closer to almost a little bit closer to 20%. So the price per spindle before COVID and the price per spindle after COVID, there is a delta of a little bit more than 20%, I would say, in terms of the price per spindle. In terms of imported components, this I'll have to split between, I assume this is for TMD is what you're asking. So TMD imported components stands closer to around 20 to 23% of the components are imported components what we use, and these are mainly on everything from metallics to electrical electronics. It covers the entire range. With respect to the PLI schemes, yes, the PLI is for it's been very well articulated and a very clear requirement as to it benefits the end garmenting companies, and it is basically to push our exports or replace our imports. So our range of machines are within the spinning range. So we are talking about blowing up to winder, and we are not talking about any equipment which we make which is beyond the winder. But we are not talking about process of weaving or knitting which comes post spinning. But however, we are very positive that when there is a pull from the knitting and the garmenting, the end garmenting customers, that is our customer, obviously it would benefit companies which are spinning units, and obviously that will go on to mean that we are going to do well as well. I think that is our take on PLI schemes for the end customer. Thank you. Back to Mr. Smith.
Thank you so much, sir. Thank you.
We have 4 more minutes, so I think we can take the question. Yeah.
Sure. We have with us Mr. Avish Bansali. Mr. Avish, you have been unmuted and we are ready for your question.
Hello.
Yes, sir, we can hear you.
Yeah, I just have 3 set of questions, one from the TMD sides. So, as the world is moving more towards the sustainable recycling side, so what are our plans on the recycling and sustainable machines manufacturing? And on the ATC side, can we get the segregation of the composite and what is the other division? Metallic side of the revenues? And also, as we mentioned on our website that we participated in the MarkTech event. So, how was the overall response from that event, and did we see any new orders or something like that? Thank you.
Sorry, I couldn't understand the third one. What is the third question?
We participated in the MarkTech event. So, did we see any new inquiries of the orders or new orders we received something about that event?
So, with respect to, I think the first question, very interesting and very good question in terms of recycling and sustainability. The entire world is moving towards recycling and sustainability in terms of fabric to fiber. And there are again 2 types of recycling, as what we understand is chemical and mechanical, and our machines today are capable of being a part of the mechanical recycling process, and our machines are also capable of handling the recycled fiber which comes back into the system. So the virgin fiber along with the recycled fiber is what goes into the system, again into the spinning process, and our machines are capable of handling this. I think that answers the first question. With respect to ATC, composites versus metallics, it is again at 10:90. 10% is composites and metallics is still 90% of the turnover is metallics as of this particular H1. With respect to the exhibition which I have attended, I think we have a funneling process. Whatever comes through in terms of inquiries, we convert it, but we don't pre-sign contracts there. It is a follow-through, and we'll be following through. We monitor them, and we follow through, and we will, it will reflect in our turnovers in the forthcoming months and quarters. Okay. Back to Mr. Samir. I think we are at 5 o'clock. I think there's one hand. I think it's Mr. Mayank. I think we can go ahead. Not much.
Sure, sir. Sure. Mr. Mayank Chaturvedi, sir, we are ready for your question.
The imported content that you talked about of 20 to 25% on the T&D side, would this largely include control equipment? And is it the same with turning and milling machines as well?
I think on an overall basis, the machine tool division has got a lot more imports. I think if you're looking at it, it's close to 30-35%, but you're right. It is on control equipments, it is on high precision, linear motion equipments. So these are all things what we import. Of course, we make our own critical to the quality components internally, but both the end control equipments, the linear motion equipment are imported, but raw material is also sometimes imported for us to make high precision components. So the import varies. What I'm trying to say is import varies from raw material to the electronic equipment. It's a range of things what we import. Thank you. Back to Mr. Samir.
Thank you so much, sir. Thank you so much. Thank you. So this brings us to the end of all the questions from all the people who raised their hands. Thank you so much, sir, for answering to all of those. And this brings us to the end of this very meeting. Thank you so much, sir. Thank you.
Thank you all. Thank you. And wish you a happy new year. And see you next quarter.
Once again, thank you so much, everybody, for being a part of this meeting. Thank you so much. Thank you.
Thank you. Thank you. I'm ending the